Welcome back to your CPA School. Today we are going to discuss earnings per share, one of the most important areas in FAR. Investors always consider EPS when trading securities. Why? Because they think a higher EPS means more benefits and less risk, whether it's dividends, capital gains, or resale value. But here is the catch. Investors often overlook about other stuff that impact EPS, like changes in capital structure, dilution, or counting adjustments. That's why understand the full mechanism of how EPS is generated and reported is critical for every investor. Many assume net income is the starting point for EPS. Sound logical, right? But no pay. There's another catch. Think of EPS as the price tag of earnings. By the end of this session, you are going to see exactly how this number is built and how it shows up in financial statements under US GAAP. And hey, if you enjoy learning with clear visual explanations, make sure you like, subscribe, and hit the bell icon so you will know when the next Farm Master Series module drops. Also share this with your colleagues or friends who are preparing for the CPA exam. Learning together makes the journey way easier. Alright, let's dive in.
The SEC reports provide a wealth of information, but the market often boils performance down to a single number, earnings per share, more than just a number. EPS is a key indicator used by investors to evaluate a company's performance and profitability. Under US GAAP, public entities must present EPS on the face of the income statement, but not buried in the notes, but displayed front and center. An entity's capital structure dictates EPS reporting. It determines how it is calculated and presented, setting the stage for basic EPS, diluted EPS, and the time travel rule. So let's see. All right. Now we are moving into the next part, capital structure and reporting requirement, the starting point. This is where the whole EPS story really starts. Before we talk about formulas or calculation, we got to understand what kind of structure a company has, simple or complex, and how that affects what gets reported under GAAP. So think of this section as the foundation. Once you get this part, everything about basic and diluted EPS will click naturally. Let's get started. A company's capital structure tells us what kind of securities it has outstanding. This is important because it sets the stage of how financial reporting will look. We divide capital structure into two types. Simple structure, when a company has only common stock outstanding. Complex structure, when a company has securities that could be converted into common stock, such as convertible bonds, preferred shares, or a stock option. At this stage, we are not yet calculating EPS. We are simply classifying the structure. Understanding whether a company is simple or complex is the first step before moving into reporting requirements. Clear? US GAAP reporting requirement. Under GAAP, the reporting of EPS depends on the company's capital structure. If a company has a simple capital structure, meaning only common stock outstanding, it reports basic EPS. If a company has a complex capital structure, meaning it has securities that could be converted into common stock, it must report both basic EPS and diluted EPS. So the type of capital structure determines the reporting requirement, right? Now let's talk about basic earnings per shares. Basic EPS shows how much of the company's net income is earned for each share of common stock outstanding. It is always reported under US GAAP, whether the company has a simple or complex capital structure. This measure helps investors see the company's profitability on a per share basis. Let's dive in. Now let's talk about basic earning per share for simple capital structure company. The formula is EPS equals to net income divided by weighted average common stock outstanding. This formula tells us how much profit is earned for each share of common stock during the period. It is straightforward. Net income at the top, WACSO at the bottom, right? When a company has a complex capital structure, we still calculate basic EPS, but we adjust the numerator. Instead of total income, we use income available for common shareholders. Here is the formula: EPS, earnings per share, equals to income available for common shareholders. That is our numerator, divided by weighted average common stock outstanding, WACSO. We can extend this formula by showing net income subtract preference dividend. It actually shows, and denominator is same, you see. So it actually shows how much of the company's earnings truly belongs to common stockholders, right? When calculating basic EPS, we must adjust net income for preference dividend before determining income available to common stockholders. So there are two types of preference dividend: non-cumulative and cumulative. For non-cumulative preferred stock, we subtract dividend only if declared during the period. For cumulative preferred stock, we subtract dividend accumulated for the period, whether declared or not. And here is the one important warning: if the company report a net loss, preferred dividends are added to the loss because they still reduce the amount available to shareholders. In EPS calculation, we apply what I call the time travel rule. It means we look back through the reporting period and adjust the number of shares based on how long they were outstanding. If new shares were issued during the year, we don't count them for the full year, only for the time they existed. So we travel through time to weight each share according to its life during the period. All right, let's dive in. The time travel rule helps us decide how to treat changes in the number of shares when calculating EPS. If a company changes the number of shares without changing total value, like a stock split or a stock dividend, we treat it as if it always existed that way. But if the change involves cash, such as issuing new shares for money, we count those shares from the transaction date only. This rule ensures we correctly determine that weighted average number of common shares or stock outstanding, WACSO, for that period. Clear? When applying the time travel rule, we look at whether the transaction involves cash or not. This is very important. The basic formula: whether the transaction involves cash or not. So there are two types of accounting treatment. One is called retroactive treatment and the other one is called prospective treatment. So when you use retroactive treatment method, no cash transaction. What does it mean? It means the transaction involves no cash. So if the transaction does not involve any cash, you must treat them retroactive basis. Clear? Means full year effect. And cash involves, if the transaction involves cash, what happens? Prospective treatment, you must do it. And meaning that effect from transaction date. Now let's see some example. Full year effect: a stock is split. Think, a stock is split. Existing stock, you just split 2:1 like this. No cash involved. Shareholders are not paying anything and company is also not paying anything, right? So no cash transaction. So that treatment will be retrospective treatment. Clear? The other one, a stock dividend. Company is paying or giving or issuing a stock, not receiving cash. Clear? So that is full year effect. Reverse splits, the same idea. What about this one? New issuance, meaning that you issue shares and you receive cash. So this transaction involves cash, right? So which treatment you are going to apply? Prospective treatment, meaning that effect from transaction date, not the full year effect. Clear? Okay. Then another one, treasury buybacks. What is that? The company is paying cash to the existing shareholder and receiving the issued shares. We call it buyback. Buyback is own shares. So that is called treasury buyback. So this transaction involves cash, right? So effect from the transaction date. Clear? When a company issues a stock split or a stock dividend, we apply the time travel rule. So what is that? A stock split and a stock dividend are treated as if they occurred at the beginning of the earliest period presented. This requires a retroactive restatement for all prior counts for comparability. If we see it in January 1, and here is the December 31st. In January 1, our outstanding share was 1 million. So before splitting, right? So split is over here. So after splitting, if there is a split, so after splitting for calculation, so we need to adjust a retroactive adjustment from January to December 31st. So 2 million shares weighted for full year, right? It is called retroactive adjustment because we go back and restate earlier share counts. Clear? Time travel rule application. When we calculate EPS, the denominator is the weighted average number of common shares outstanding or workshop. Each share count is weighted based on how long those shares were outstanding during the year. Here we start 10,000 shares, January 1 to December 31st, 10,000 shares, January 1 opening. So weighted for full year. So there is the calculation procedure. 10,000 times 12 divided by 12 equals to 10,000. Full year means actually 1. Then this transaction plus here issue 2,000 shares. This transaction involve cash. So where time travel rule says you need to calculate from where? From the transaction date. So from transaction date to the year ending date, it is a 9 months. So the weight will be 9 divided by 12 means 9 months out of 12 months. So now we need to consider the what is the effect of those shares or how many shares are required to effect for the full years based on this available information. So 2009 months times 9 divided by 12 equal to 1500. This 1500 meaning that the if we consider January 1 to December 31st, the shares number of shares will be 1500, which is equal to 2000 shares issued on April to December, the same effect. And December 1st, we reacquired shares, 1000 shares we reacquired. It is December 1 to December 31st is 1 month. So 1 month weight, right? So 1 month out of 12 months. So what is the weight? 1000 shares times 1 divided by 12 equal to 83 shares. Meaning that 1000 shares 1 month equal to 83 shares for the full years. You understand? And this 83 will be subtracted. Why? Because you reacquire, you buy back your own share. This is actually treasury stock, right? So this reacquire actually reduces the outstanding number of shares. So 10,000 plus 1500 minus 83 equals to 11,417 is the number of, it is workshop, weighted average number of common stock outstanding, which is later used in the calculation of EPS. Clear? Now we move to diluted earnings per share, often called the stress test for EPS. It shows what would happen if all convertible securities like options, warrants, or convertible bonds were turned into common shares. This test helps us see the worst case scenario for shareholders where earnings are spread across more shares. So diluted EPS tells us how strong or vulnerable the company's per share earnings are under full dilution pressure. Let's dive in. Diluted earnings per share shows the lowest possible EPS a common shareholder could end up with. It assumes that every potential share from option, warrants, or convertible securities turns into common stock. This is the worst case scenario because most shares mean each one gets a smaller portion of the company's earnings. Even If those conversions haven't actually happened, the calculation pretends they did. That's why it is called a stress test. When we calculate diluted EPS, we test certain financial instruments to see if they could reduce earnings per share. The main instruments are convertible bonds, debt that can be converted into common stock, convertible preferred shares that can become common shares, option and warrants, rights that allow holders to buy common stock at a set price. Each of these instruments is tested to see whether conversion or exercise would dilute earnings per share.
When we test securities for dilution, we ask one simple question. Does EPS decrease when the security is included? If the answer is yes, the security is dilutive, meaning it reduces earnings per share, and we must include it in the diluted EPS calculation. Now let's look at this visual. It's about dilutive securities. Think of the basic EPS as our baseline. That's the weight on the left side of the scale. When we test a potential security like options or convertible, we ask, does adding this security make EPS go down? If the answer is yes, meaning the EPS baseline decreases, then that security is dilutive and we include it in the diluted EPS calculation. Notice how the scale tips downward on the right? That's the visual cue showing dilution. The heavier the dilutive security, the lower the EPS value becomes. So the key takeaway include only those securities that reduce EPS. They are dilutive. That's the logic behind identifying dilutive securities. Alright, now let's look at the opposite side of the story, anti-dilutive securities. Here is the idea. When we test a potential security, we check what happens to our EPS baseline. If adding the security makes EPS go up, that means it's anti-dilutive and we ignore it in the diluted EPS calculation. See the scale in the visual. The right side lifts upward. That's because the anti-dilutive security increases the EPS figure instead of reducing it. And remember this golden rule. Diluted EPS can never be higher than basic EPS. So, if testing a security improves EPS, it is not part of the dilution. It is excluded. Only those securities that decrease EPS are considered dilutive. In short, anti-dilutive securities make EPS rise, so we leave them out. That's how we keep the diluted EPS calculation realistic and conservative. When we apply dilution methods, we use two distinct approaches. Depending on the type of instrument, first the treasury stock method used for options, warrant, and their equivalents. Under this method, dilution occurs only when the exercise price is lower than the average market price, because that means new shares would be issued below market value. Second, the if converted method used for convertible bonds and convertible preferred stock. Here we assume the securities are converted into common shares and add those shares to the total, but only if the conversion actually reduces earnings per share. Together, these methods ensure we capture every potential source of dilution accurately. Alright, let's dive in.
The treasury stock method assumes proceeds from exercising in the money options are used to repurchase shares at the average market price. Dilution occurs because the exercise price is lower than the market price, so fewer shares are repurchased than issued. The net increase in shares is the dilutive effect. In this example, you can see they exercise 1000 options at $15. So $15 is the exercise price. And step 2, if you find over here, so $20 as the average. So exercise price is lower than average market price. So you need to you receive cash by issuing 1000 shares, right? You issued 1000 shares and received cash 15,000. That 15,000 proceed used to buy back shares at $20 average price. So how many shares? 15,000 divided by 20 equals to 750 shares that you can repurchase. So repurchased share is 750. You see, minus sign is over here, plus sign is over here, because it is increasing and it is decreasing the number of shares outstanding. So the net effect, net dilutive effect is 250 shares. That should 250 shares should be added to the WACSO denominator. That is net dilutive effect from the treasury stock method. Understand? The if converted method. The if converted method assumes convertible securities were converted at the beginning of the period, requiring adjustment to both the numerator and the denominator of EPS formula. You see over here, convertible bonds, numerator effect, add back interest expense net of tax. Net of tax means after deduction the tax. The formula is here. If interest expense, you can put the here, then times the 1 minus tax rate. If 30%, so 0.30. So 1 minus 0.30 is 0.70. So if it is 1000, so 700 should be added back to the net income. Denominator effect at common shares from assumed conversion. Clear? Now, convertible preferred stock, numerator effect. Do not subtract preferred dividend or add them back if already subtracted. If you do not subtract, do not need to add. So no tax effect over here. Dividends are not tax deductible item. Denominator effect, same. Add common shares from assumed conversion. Clear? This is very important for CPA exam. Basic earnings per share. Example scenario. Net income 100,000 US dollar. Workshop 100,000 shares. Convertible preferred stock 10,000 shares paying $20,000 in dividends. Each share is convertible into 5 common shares. So remember, the convertible into 5 shares, this condition we will not use. When we calculating basic earnings per shares. We only need workshop and net income and preference dividend for other issues. So what is the formula? Net income minus preference dividend divided by weighted average common stock outstanding. So net income is $100,000, dividend is 20,000 USD divided by 100,000 shares, right? Then EPS equals to 80,000 divided by 100,000 equals to EPS 0.80 shares. So what is the conclusion? Conclusion is the reported basic EPS equals to $0.80. Clear? Diluted EPS. Example scenario. Net income $100,000. Workshop 100,000 shares. Convertible preferred stock 10,000 shares. Paying $20,000 in dividends. Each share is convertible into 5 common shares. That is the conversion rule. So EPS equal to income available for common stockholders plus preference dividend. Weighted plus preference dividend. Actually, while calculating basic EPS, we already deducted 20,000. That's why we need to add them back. That's why over here is the plus sign. In the previous sum, in the basic earnings per share, it was 80,000. So we take 80,000 from them plus 20,000 dividend back. Because when it is converted, you are not paying any dividend to anybody, right? Because no preferred shareholder. They will become a common stockholders. Weighted average common stock outstanding 100,000 shares previously, and it is now 50,000 more. So how? There is a conversion rule. For one preference share equals to 5 common shares. So for 10,000 preference shares, you will issue 10,000 times 5 equal to 50,000 common shares you need to issue, right? So the calculation says 0.67. Now the check for anti-dilution. Here is a simple question. Is $0.67, I mean diluted, is lower than 0.80 basic? The answer is yes. So the conclusion is the security is diluted. The security means preferred stock is diluted. The reported diluted EPS is $0.67. Clear? This summary brings together everything we have covered about earnings per share. There is a table, we call it summary table. In this table, we show denominator and numerator for basic EPS or diluted EPS. For basic EPS, common stock, we use workshop, weighted average, common stock, outstanding. The same, weighted average, common stock, outstanding. No adjustment for the numerator. Clear? For option and warrants, we should only consider in case of dilution. So what dilution method are used in the case of option or warrants? Treasury stock method. It is a dilution method. The add incremental shares if diluted. How do you know that the options are diluted? When you see the exercise price is lower than average market price and there is no other adjustment is required for numerator. Convertible bonds not included in the EPS, no adjustment is required. If converted method, this is the dilution method. We are talking about denominator. Add shares from conversion if diluted. How do you know that diluted? When after inclusion this bond, if EPS is lower than the basic EPS. So this security, if this security is dilutive, then only is included, right? Then in the case of dilutive, you need to adjust the denominator by adding shares from conversion. And you also need to adjust the numerator by adding back the interest net of tax. Convertible preferred stock not included if conversion method is used. Add shares from conversion if diluted. Add back preferred dividend if subtracted earlier. No tax effect is over here. So this toolkit helps analysts quickly identify which instrument affect EPS and how to adjust both the numerator and denominator correctly. Right? Now that we have covered all the key EPS concepts, basic, diluted, and related methods, it's time to apply them. In this scenario-based exercise, we will test how well we can identify dilution effect, adjust numerator and denominators, and interpret results under different conditions. Clear? Let's dive in. Scenario Lab 1. West Company had earnings per share of $15 for the current year before considering the effect of any convertible securities. No conversion or exercise of conversion securities occurring during the year. However, possible conversion of convertible bonds would have reduced earnings per share by 0.75. So reduce, so it is dilutive. The effect of possible exercise of common stock option would have increased earnings. This is anti-dilutive because as it is increasing. So there are two things. The convertible bonds are dilutive and stock options are anti-dilutive. So anti-dilutive we should not include. Dilutive we should include. When? When we calculating the diluted earnings per share. What is the call of the question? What amount should West report as diluted earnings per share for the current year? So call of the question is diluted earnings per share. Okay. Let's see what is the result. A, $14.25. B, $15. C, $15.10. D, 14.35. So calculation, basic EPS, that is our baseline, $15. Let's reduce by EPS by convertible bonds, right? 0.75. So diluted EPS is 14.25. A is the answer. Clear? Scenario Lab 2. Ion Company is calculating earnings per share amounts for inclusion in Ion's annual report to shareholders. Ion has obtained the following information from controller's office as well as shareholder services. So net income from January 1 to December 31st, 125,000. Number of outstanding shares, January 1st to March 31st, 15,000. April 1 to May 31st, 12,500. June 1 to December 31st, 17,000. In addition, Ion has 10,000 incentive stock option with an exercise price of $30 to its employees and a year-end market price is 0.25 per share. What amount is Ian's diluted earning per share for the year ended December 31st? Very simple, but very important. So what is the answer? 7.35, B 4.63, C 7.94, D 4.85. So here is the calculation. Workflow is important over here. So 15,000, 3 months. So what is the weight? 3 months out of 12 months. So 15,000 times 3 divided by 12. 12,500, this is 2 months. 2 by 12. 17,000, it is 7 months. So 7 divided by 12. So if you calculate it, we get 15,750. That is workshop. And here if you see, the exercise price is 30. It is more than market price. So it is anti-dilutive. You should not include it. Clear? Yes. So diluted EPS is, what is the net income? 125,000. 125,000 and workshop is 15,750. 7.94. C is the answer. Clear? Scenario lab 3. Jones Corporation capital structure was as follows. There is year 1 and year 2. So December 31st. The outstanding shares of stock. Common 110,000 both the year. Convertible preferred stock 10,000 both the year. 8% cumulative bond, 8% convertible bond, 1 million both the years. During the year, Jones paid dividend $3 per share on his preferred stock. $3 per share, 10,000 shares, so 30,000. The preferred shares are converted into 20,000. If you issue this 20,000, you need not to pay the dividend, right? Because their the convertible preferred stock will become the common stockholders. So you don't need to pay 3 times 10,000, 30,000. Like that, 8% bonds are convertible into 30,000 shares of common stock. So now currently it is 1 million. If you issue 30,000 shares to them, so they will become a common stockholder. So in that case, no convertible bonds will be available. So in that case, you are not going to pay any interest to them, right? Because 8% on 1 million, you are going to pay every year as an interest expense. Net income for the year 2 is 850,000. Assume that income tax rate is 30%. So the diluted earnings per share for year 2 is A, $5.81, B, $5.48, C, $6.26, D, $5.66. So we need to pick out the correct answers. So in that case, we need to calculate the diluted earnings per share, right? So diluted EPS, net income plus interest expense 1 minus tax, means add back the interest that would not be paid anymore, right? So in that case, we add them back, but remember, it will be net of tax always and workshop. Then again, diluted earning per net income. What is the net income? We found net income is 850,000, and here is 80,000. How much? How 8% of 1 million, 80,000, and tax rate is 30%. So 1 minus 0.3, meaning that 70% of 80,000 you need to consider, right? Then here is 110,000 plus 20,000. 110,000 plus 20,000 for common stock for preference and 30,000 for convertible. So all are converted, right? Then the dollar $906,000, 850 plus 56 divided by 110 plus 20 plus 30, 160,000. So what is the diluted earnings per share? It is divided with 5.66. So what is the answer? 5.66. The answer B, right?
Alright, let's walk through this visual. This is the story behind EPS. Everything starts with company's earning source. That's the pipeline on the left. From here, earning flow through capital structures, which can be either simple or can be complex. If the structure is simple, the company only reports basic EPS. That's calculated as net income minus preferred dividend divided by WACSO. And remember time travel rule. The treatment depends on whether the transaction involves cash. If the transaction does not involve cash, like a stock split, reverse split, or a stock dividend, we apply retroactive treatment, meaning we restate as if it happened at the beginning of the period. That gives a full year effect. But if the transaction does involve cash, such as new share issuance or treasury stock buyback, we apply prospective treatment, meaning the effect starts only from the actual transaction date. If the structure is complex, the company reports both the basic and diluted, basic EPS and diluted EPS, complex capital structure. In case of capital structure, this is where dilutive and anti-dilutive rule comes in. A security is dilutive if it decreases EPS and anti-dilutive if it increases EPS. We ignore the anti-dilutive ones. Now, we move into the dilution methods. For option and warrants, we use treasury stock method. It's dilutive only the exercise price is below the market price. There is no numerator adjustment here. We just add the incremental shares to the denominator if it is dilutive. For convertible bonds and convertible preferred stock, we use if converted method. That means we assume they were converted on day one. For bonds, we add back after tax interest to the numerator and add shares from conversion to the denominator. For preferred stock, we add back preferred dividend to the numerator only if they were subtracted earlier in basic EPS. If they were not subtracted, no adjustment is needed. Then, as with bonds, we add shares from conversion to the denominator, but only if the conversion is dilutive. All of that leads us to diluted EPS, the worst case scenario where every potential share turns into common stock. So in short, this slide shows how a company's capital structure determines whether we stop at basic EPS or go further to diluted EPS, and which method we use to test for dilution. That's the full story behind EPS. When you understand both basic EPS and diluted EPS, you are not just calculating, you are decoding the price tag of earnings under US GAAP. That's it for this module. In the next one, we are going to look at stockholders' equity. Let's keep rolling. And that brings us to the end of today's session. We have journeyed through the essentials of EPS reporting, from capital structures to basic EPS and diluted EPS, and wrapped it all up with clarity and confidence. Thank you for staying engaged in learning with me. If you found this lesson helpful, please like, share, and subscribe to the channel. And don't forget to press the bell icon so you are notified when the next FAR Master Series lesson drops. Remember, in accounting and reporting, concept first, confidence always. See you in the next module.